Good morning, students. In today's session, we will discuss about the term loans. What is required? In the last class, we discussed about the need for financial planning, and now we'll discuss about the term loans. So, term loan is a short-term, long-term loan approved and disbursed by any financial institution. The offered loan amount will be repaid in regular payments, such as equated monthly installments. In short, it is known as EMIs over a defined period of time. So, term loans can be offered in both fixed and floating rate of interest. The repayment texture of a term loan for business purpose is usually between 12 months to 60 months. Term loans are offered among various lending products like business loan, personal loan, home loan, education loan, etc. Now we'll see the purpose of term loan. Term loan can be used for various business purposes such as business expansion, to purchase the equipment, machinery, or raw materials, to manage the cash flows, to meet the working capital requirements, to buy the office or business space land, to pay off the rent, salaries, hiring new staff, or the debt consolidation. For all these purposes, we can use the term loan. So term loan eligibility, if you see the age criteria, minimum age of the applicant should be 18 years at the time of term loan application and maximum should be 65 at the time of loan retirement or maturity. And this may also change at times. So the applicant with good repayment history and high credit worthiness should come in the other term loan opportunities. Applicant should progress good credit score or CIBIL score, ideally above 100. Applicant should maintain regular source of finance. Applicant with no defaults with any financial institution, they can only apply for the term loans. Term loan interest rate, if you see, term loan interest rates offered to application shall vary from bank to bank and mostly it depends on the applicant's profile and business requirements. The good credit score also plays a vital role in getting term loans at lower interest rates. Term loans interest rates offered by banks are comparatively lower as compared to the other lending institutions. Now we'll see what are all documents are required for applying for term loan. Self-drafted business plan, then duly filled application form with passport size photograph, then KYC documents like identity, address proof, age proof, and so on, like passport, PAN card, Aadhaar card, voter ID card, or driving license. You can use this for as documents. Utility bills, electricity, telephone bills, or waterway bills, all this can be used, suppose, if we don't have any of the other background papers. Then business establishment proof we should produce. Then last 12 months bank statement, minimum turnover as per bank or lender, then any other document requested by the bank or society. So all these documents we have to provide support. The next one is capital structure. The capital structure is a particular combination of debt and equity, debt capital and equity capital used by a company to finance its overall operations and growth. Equity capital arises from ownership shares in the company and it claims the functions of the cash flows and profits. Debt capital is a form of bond issue of share loans, where the equity may come in the form of common risk, preferred risk, or retained earnings. Short-term debt also is said to be part of the capital structure. Now we'll discuss about export finance. It is no exaggeration to say that finance is the lifeblood of any business. As an exporter, funds received through your financing channels may be used in the preliminary stage while incurring the capital requirements or expenditures. So of course you will want to need to find the funds that are needed to make the business production ready for day-to-day working capital requirements or to meet the unforeseen contingencies. But now let us see what is the working capital requirement. The additional capital that is required in the business in order to run the day-to-day business affairs is known as working capital. So there are two forms of capital, fixed capital and working capital. Fixed capital means in the initial stage when we are starting the business, the capital what we require to start the business is known as fixed capital. Working capital means the additional capital that is required by the business in order to run the day-to-day affairs of the business is known as it is actually known as the business financier or the working capital. So why do you need to have export finance? Pre-shipment, post-shipment, finance against collection of invoices, letter of credit, and so on. Now let us see about the pre-shipment finance. Pre-shipment finance provided when an exporter needs funds before the shipment of products or goods. Funds are required for purchasing raw materials, processing of raw materials into finished goods, and packaging the goods, etc. Packing credit. You can avail pre-shipment finance from your financier against SAS, export order received from the importer in the form of packing credit. Once the funds are received from the overseas buyer, the concerned export packing credit amount will be adjusted and loan will be closed against that particular order. Now we'll see about post-shipment finance. After you have shipped the products and raised an invoice from the importer, you will have to see through the credit period until you receive payment from your buyer. You may need working capital for this period to fulfill the other orders. So this can be resolved with the most shipment finance from the following sources like bill discounting and invoice factoring. You can approach your bank or a financial institution to present your invoice to them for factor liquidation. So this particular banker or the financial institution, they may provide the products. There is a sell and products collect or even discount the bill. Post-shipment finance under the letter of credit discounting. Banks are often ready to finance against letter of credit as there is an inbound security in the confirmed letter of credit that the issuing bank will make the payment in case of default. Next one is angel financing. Angel financing refers to an investment model wherein the business of angels, especially the high net worth individuals, provide financial backing for small businesses in exchange for equity in the company. Angel financing can be a one-time investment or it can be referred to as ongoing support. So generally, angel financing is a high risk, high reward, or angel investors tend to seek a more favorable return of the than would be provided by a traditional investment opportunities. So how angel financing works for the entrepreneur. Firstly, business angels they find out about interesting startups from a broad range of sources relating to including the other entrepreneurs, investors looking for partners or other angels within the same network fund and so on or any group. After an initial screening process, they will invite the prospective startups to pitch, and if the pitch goes well, they will decide to invest. This is how angel financing works. So when it comes to angel financing for entrepreneurs, it's important to note that the investor wouldn't sit back and wait for you to get the back rolling. Angel investors play a much more active role in the business. So they will provide the founders with advice, make introduction, build your own network, and help to guide you thoroughly based on the subsequent funding resources. So what are the advantages we have in case of angel financing means an angel investor they provide financial backing to entrepreneurs and early stage investors or startups. Angel financing is far less risky than debt financing because you won't need to repay the investment capital. Then if it also worth remembering that angel investors tend to think long term or they won't be looking for an immediate term. Immediate returns they won't concentrate, they concentrate only long term returns. Finally, because angel investors are angels, they take a more accurate and active role. You will receive access to their contacts and sector knowledge, which can help to speed up the company's growth in the biggest positive way. So the drawbacks, as a coin has two sides. When we have advantages, we have some drawbacks also in angel financing. Some of the drawbacks are we think about the loss of control that you need to deal with. The biggest negative for many is giving up the equity or shares in the company. Then if you accept angel financing, you will also need to comfortably with the fact that your investor will have a say in how your business to run, as well as receiving a share of the profits when the company is sold or to make profit. The next one is venture capital. Venture capital is a financing tool for companies and an investment vehicle for wealthy individuals and institutional investors. Wealthy investors like to invest their capital in startups with a long-term growth perspective. This capital is called venture capital, and the investors are also called venture capitalists. In other words, it's a very common form of companies who they try to receive money in the first term and for the investors to grow wealth in the long term. Venture capitals tend to form on emerging companies, and such investments are risky as they are illiquid, but also the potential to provide impressive returns if invested in the right venture. A venture capital can finance a company by equity participation and in capital gains, participating in debentures and extending conditional loans to the firm. Crowdfunding is the use of small amount of capital from a large number of individuals to finance a new business venture. Crowdfunding makes use the easy accessibility of vast networks of people through social media and over crowdfunding websites to bring investors and entrepreneurs together with the potential to increase entrepreneurship by expanding the pool of investors beyond the traditional circle of owners, relatives, and venture capitalists. So crowdfunding will put money in a business bank account without adding to the ventures their debt load. So in today's class, we have discussed about the different term loans that are used in the business financing. Thank you.